According to 10X Investments Chief Executive Officer Steve Nathan, research shows that there's simply too many active managers. He's with us in our Cape Town studio. I published your research over the weekend, Steve, and had the chance to read through it, or the research rather that you brought in from abroad. And it does appear as though it suits your game. It suits your book, being a organization that focuses on cutting costs and also on passive investments. Just articulate for us, though, the strongest part of this argument for you.
Well, the facts show that trying to beat the market, or what's called active management, is a zero-sum game, and by that it means that for every winner there's an equivalent loser. So if I would have bought Naspers in the last year, I would have earned an above-average market return, which would have enhanced my portfolio return, but I had to buy it from someone, and that someone would be the loser, so their return would be lower. So for investors as a group, trying to beat the market is a zero-sum game before fees, but it's very expensive to play that game because fund managers charge high fees. Those few fund managers that do outperform want performance fees, so they charge you even more. The fund managers that underperform don't write you a check back to say, I'm sorry. So it's heads, they win, tails, you lose. And the more you trade, you incur brokerage through stockbrokers, you pay tax to the government every time you buy a share. So those costs increase all the time. So it's impossible for the average investor to earn the market return. They can only earn that less the total cost of investing. And the higher those costs, the further you're going to be away from the market average. And that's why academic research shows that owning the market at a low cost produces a superior long-term return compared to most active funds, but not all.
Stephen, some say that you are talking your own book here, given the fact that 10X is a passive, or rather has a passive investment strategy.
Well, it's not our research that we're talking about. It's independent research from Nobel Prize winners, and this particular piece of research was from Towers Watson, which is one of the largest asset consultants in the world. So it's simple arithmetic. The mathematics and the logic behind index funds is not questioned. The industry, however, believes that they are the 1 in 10 or the 2 in 10 that can beat the market. So active management is really selling hope. So it's a bit like the casino. When you go into a casino and you hear the one-armed bandits ringing, always the machine that pays out the jackpot rings very loudly. You only wish it was your machine. And that's a bit like active management, is that it's possible to beat the market, but the probability is very low. And what we're seeing from academic research, if you had the time to read the Financial Analyst Journal, you'll see that the investment industry is coming under a lot of criticism from internally and saying, are we a profession or are we a business? Because if we are a profession, then we should do things that add value to our long-term clients, and that isn't trying to beat the market. That's really constructing portfolios that are appropriate to meet people's long-term goals rather than trying to focus on the short-term speculative activity of active management.
What Towers Watson also concluded, that there are too many active managers. So they're not saying you don't need active managers, but there are too many of them. Now, how are they going to become extinct?
Well, firstly, it's a very brave admission from Towers Watson, because a large component of what they're selling is really trying to pick the winning fund managers. So we commend them for the intellectual honesty of coming out and saying that for most people there are too many active managers. I think one of the issues that the active managers throw into the pot is to say, well, if everybody indexes, then there's going to be no price discovery and markets are going to be inefficient and everyone's going to suffer. What we're talking about is that for most long-term investors, retirement fund savers and other long-term investors, the best way is to index. But to the extent that there's ever a mispricing opportunity in financial markets, there are so many people looking for mispricings. There's bank traders, there's hedge fund traders, there's day traders, there's wealthy individual investors. So I don't think we'll ever see a situation where there are no active managers. And that's also what Towers Watson have said, is that there will always be some players around, but at the moment, about 85% of assets are being managed on an active and expensive basis. And that number should come down dramatically to better serve investors.
And that's an interesting point you make there of the 85%. I'm not sure if that's a South African or a global number, but we've just got the latest figures coming out to show that once again, Coronation is by far the biggest asset management company. Well, Coronation followed by Alan Gray. What is it that the South African market's missing here?
Well, I think the South African market is a very heavily intermediated market. So advisors and financial planners and brokers and tied agents tend to dominate the way people invest. Whereas if you look internationally, people are far more empowered. If you look at the US and Europe, people have taken ownership for their own investments because they've been pretty disillusioned by what the industry has done on their behalf. And in South Africa, we're quite a long way behind that. Very recently, in fact last week I think it was, the Financial Services Board has come out with proposals to improve the distribution of products, because even according to the Financial Services Board is that distribution in South Africa is very conflicted and often it leads to bad outcomes. And a bad outcome would be that very few people are investing in low-cost index funds.
Would the industry locally be open to change, Stephen?
Well, it doesn't suit the industry to change because that's their business model. So it's very hard to get reform. You know, we've had so much reform in South Africa. We've had FASE, which regulates advice. We've had treat customers fairly. We're now getting RDR, the distribution review, and they're all trying to do the same thing. Now, the industry, whenever they see these proposals, they say they welcome them. But that can't be true, because if they welcome them, they've reformed themselves, and we wouldn't need the regulators to keep on banging their heads with a stick rather than with a carrot.
Steve Nathan is the Chief Executive of 10X Investments.